Hey everyone, we're Matt and Michael from the Webb & Young Group, Remax Hallmarche Realty.
And this is the Real Estate Roundtable.
Today we have an amazing guest with us, Michelle Donahue, who's going to talk about everything regarding mortgages.
Thank you, Michelle, for joining us today. We're thrilled to have you here.
So, Michelle, of course, Michael and I know you quite well, but for the viewers who may not know you yet, can you tell us a little bit about your background and how long you've been helping clients with mortgages?
Yeah, absolutely. So I've been an agent now for 11 years. I'm licensed in Ontario, so I can help anyone pretty much in Ontario. My region tends to be around the Simcoe County area, down to Toronto, out to Kawartha, and up to the Muskokas. I pretty much help everyone from, I have a lot of first-time homebuyers, a lot of the self-employed individuals. I also deal a lot with high net worth clients, so my doctors, accountants, who have more incorporated incomes, and people with large companies with bigger business financials, to basically working with people who are severely credit challenged. And that's kind of a soft spot for me, is working with those individuals and teaching them about credit. But yeah, those are primarily the clients that I have.
So, Michelle, I'm interested. What actually drew you into the mortgage world originally?
So, I actually got into the mortgage industry. My sister works for another broker, and I had a conversation with this broker, and was pretty much captivated by it immediately. I found it quite interesting, as well as my father was a realtor, or my father-in-law was a realtor. And so from day one, I've only ever used a broker. We've never walked into a branch for a mortgage. And so my personal experience was only dealing with a mortgage broker. So I was already very familiar with the process. And I understood immediately the value of having someone advocate for you versus walking into a branch and you have to advocate for yourself. So that kind of made me interested in the actual position itself. What's really kept me in the industry is actually the education side of this. I don't think people realize how much brokers have to know. We have to have a fairly strong understanding of the economy, monetary policy, fiscal policy, budgets, geopolitical issues like presidents and wars. All of these things actually impact our housing market and interest rates in a roundabout way, and we have to be able to understand them and interpret them and be able to educate our clients in a way that's not overwhelming. They don't need to be economists, but we need to help guide them so that they can make good decisions on when is the right time to buy or sell, and how do I renew or refinance. So that, I would say, is the part I love the most, is the education aspect of this, and taking my love and interest in the economy and interpreting in a way that's tangible for most people.
Michelle, that's one of the things that Matt and I enjoy most about working with you.
Thank you. I appreciate that. It's, I think people think the economy is more difficult to understand than it really is. And what I find so fascinating about it, everything impacts housing and interest rates.
Absolutely.
And you can take any news story, and I can find a way to link it back to how this is going to impact my buyers, my sellers, my people refinancing. And so I try to make it interesting, because there's only so much we can do to make talking about mortgages and interest rates interesting. Mm-hmm. And so I really try to explain it in stories and ways that can, make most people understand it in the most simplistic way. And again, knowledge is power. And so people make better decisions when they have more knowledge.
Absolutely. And, that's one of our mottos. That's actually one of the reasons Matt and I launched this program, because we are firm believers that knowledge is power. So you've alluded to the fact that, there's a lot of factors that kind of influence, mortgage rates and fundability. And so with that in mind, what should Canadians expect from the Bank of Canada over the next year?
They have a big job. But first, I want to kind of highlight what it is exactly that is the job of the Bank of Canada. So the Bank of Canada is essentially a crown corporation. It acts independent of the federal government. All countries around the world have a central bank. And so they have 5 core functions, but the one core function that impacts the greatest is going to be monetary policy. And the main mandate for monetary policy is to keep inflation low and stable. And so monthly they do this, or sorry, not monthly. Monthly they look at stats, or CPI numbers, and they kind of make decisions based off of that. So 8 times a year they have policy rate decisions. And so right now what the Bank of Canada is looking at in terms of what they're taking into consideration for those next rate policy decisions are going to be, we're seeing inflation right now where you have it around like headline inflation, which is the inflation you and I feel, that's everything, is in around 2%. And core inflation, where is they really take that more into consideration. And that's when we remove things like food and gas. And the reason why they do that is because those are very volatile parts of all of the baskets. And they're really kind of more determined by external forces outside of the central bank. So for them, they're looking at core inflation, keeping it within their mandate. They're also looking at job numbers, and they're looking at how the economy is performing. Now, part of those numbers are like military investment. So it's not that our economy is all of a sudden doing fabulous. It isn't. It's still sluggish. But they are going to be watching that very closely. They're going to be watching productivity and capital investments from the federal government. And the reason why they want to do that is because think of productivity is the way that our economy is able to produce goods and services in a more efficient way. And for Canada, we have really lacked productivity for the last 25 years. It's a major issue actually for our country. Hopefully, we're going to see some improvement in that area. We'll see. And pretty much they're going to be watching those 3 things. And right now, the Scotiabank is the one bank, and this is actually I provided a chart for you, so you'll be able to put that on the screen. Scotiabank has kind of stepped away from the other 5 major banks in terms of their projections for policy rate decisions in 2026. They're actually anticipating potential for 2 rate hikes at the end of 2026. Now, in order to make, for the Bank of Canada to take into consideration a rate hike, they have to see that inflation is like well under control. They have to see that the economy is performing well. But basically, most of the major banks are looking at potentially just a hold for now. One is actually calling for a decrease. I don't really see that happening. In order for there to be a rate cut, we would actually have to see the economy like almost going into a recession, because the Bank of Canada will use policy rate decisions to stimulate the economy. And when the economy is not performing well, they'll cut interest rates to help kind of boost investment and encourage spending, basically. But right now, we can anticipate more stable rate decisions. I think all the cutting that they needed to do is pretty much done. We're probably going to see a hold on December the 10th, and just kind of more stable environment, assuming no bad news comes from the United States with the tariffs in June. But for now, stability is what I think is the key word for 2026.
Well, BOC, the Bank of Canada, had kind of advised us when they did the last rate announcement that in all likelihood we would be in a holding pattern for the foreseeable future.
Yeah,
so that's not really big news.
No, it's not. And for them, we don't want them to meddle. that much. We want them to kind of just like only when they absolutely need to. And really the only reason why they would ever do a cut right now at this point, it would just simply to stimulate the economy. But if the economy, like our GDP numbers, and if we're still seeing investments and the economy is chugging along, it's not doing great. Like obviously we need a lot of work, but if as long as we're like maintaining, they're not going to cut. So I'm really more looking to see more holding, and that provides the stability that businesses need to see so that they can go ahead and make investments in their company and not pull investments back.
Yeah, that makes total sense. I know for me, Michelle, I get this asked often by my clients, Michael's clients as well. I'm more of a fixed rate mortgage type of fella. I like security. But how should buyers and homeowners approach choosing between fixed rate and variable rate mortgages right now? What's your thought on that?
So it really comes down to three main things. It's going to be risk tolerance, your financial goals, and the economy. Risk tolerance is going to help you decide between fixed versus variable. If you're someone who likes the stability and wants to know what your exact mortgage payment is going to be for the course of your term, well, then a fixed rate is going to be better suited for you. If you're someone who worries about or who would worry about the potential for a change in their mortgage payment, definitely a fixed rate. Now, a variable rate is going to be better suited for someone like an investor, someone who has a rental property, someone who potentially might need to break their mortgage, someone who has the financial maturity. And by maturity, I mean more, they have assets, they have investments and things like that, and they can handle the ups and downs that comes with the variable, but they want the benefit of the savings and interest that we typically see on a variable over the course of a 30-year period. Now, the next thing is financial goals, and it's nothing cheesy here. It's more just, is there any potential that you might need to break that mortgage over the course of the next 5 years? Well, then you're going to want to make sure you're choosing an interest rate and a term that's going to allow you to do that. A variable, if you know you might need to move in 3 years, well, you're going to go with a variable or a shorter term fixed. So that's why it's important to kind of have a sense of where the direction of your financial goals are. And lastly, it's going to be the economy. 2024 is a really great example of how we were choosing interest rates based on the economy. So when rates were really, really high in 2024, you didn't want to lock into a 5-year fixed, because that means you're in a high rate for 5 years. So if your ratios allowed for it, you were in a 2 or a 3-year term. And that way you can access lower interest rates sooner versus being in a high rate for up to 5 years. People often go with whatever the lowest interest rate is, but that's the worst mistake you can make. The biggest savings actually comes from choosing the appropriate rate type and term for those 3 particular scenarios. And the last point would be that for most people, it actually comes down to what do you actually qualify for. Although ideally, I'd like to see some of my clients more in a 3-year fixed, but if they only qualify for the 5-year, your ratios have to qualify you for your particular interest rate. Right now, we are seeing with some variable, the discount on variable was not really great. Now it's better, and we're actually seeing some variable, like on insured business, being less than where fixed interest rates are. So provided you can handle, the other 3 points that I made, then you can we can make the decision based on the interest rates that way. Most people, which I do have a graph I've provided you with for this, most people, 43% of people are actually opting for a 3 or a 5-year fix. And I think that has to do with the fact that, we saw variable prime rate spike the way it did. And so people are a bit gun shy on that, rightfully so. But really the pricing on the 3 and the 5-year has come down so much that they're pretty much almost the same right now. So you have that flexibility to choose the 3-year, or you can go with the 5-year if you want to be able to hold that lower interest rate for longer.
So this is an interesting, topic of discussion, Michelle. And, we have seen quite a bit of rate volatility in the last few years. Pre-apocalypse, mortgage money was relatively free. And then we saw quite a steady increase in recent history in mortgage rates. And personally speaking, I had to renew my mortgage last September, and for the first time in my life, I went with a variable rate because all indicators were demonstrating that the rates were going to continue coming down. And of course, I didn't want to get locked into a fixed rate when I knew that the rates were coming down. And so with that in mind, are there specific signs that we can watch for that might suggest fixed rates may or may not drift up or down?
I think we can expect stability. I really do. When we saw interest rates go down to 199, I think actually 189 was the lowest interest rate I got someone. They were that low because of something called quantitative easing. And that is a policy tool where the Bank of Canada has purchased government bonds and treasuries, and that provides financial liquidity to the financial system. And in return, the banks are able to then lend money at a much lower interest rate. Rates were artificially low. That's not normal interest rates. Normal interest rates are actually where we are right now. And so there's really the Bank of Canada only uses that tool in extreme scenarios. And so we're not in a place with those factors that were causing them to do that have all since resolved. And so really, we're looking at stable interest rates for the next little while. Things that really kind of cause our fixed rates to go up and down are actually more, the headlines that you see in the news. So anything news that's coming out of the United States, wars, geopolitical issues, those are the types of things that actually cause our bond yields to go up and down. Reports, GDP numbers coming in strong on Friday actually cause our yields to go up. And for every 15 basis points that we see movement in yields, that's typically when we see a rate change. The main thing that I would say about fixed rates is just make sure that you're working with a financial professional who's watching the bond yields and knows when to act. On a Friday evening, like wherever I go, my laptop comes with me because I have to be able to act quickly, because it potentially means that my clients who have tight ratios and are buying, they may not qualify for that mortgage if I didn't hold that fixed interest rate for them.
Right.
But
I
right
think
now,
it might also be.
Stability.
I'm sorry?
But for now, I think we're looking at more stable interest rates and not such huge swings in interest rates, like maybe 5 to 10 basis points.
Okay. So, I'm certainly, because of course I've just copped the fact that I'm in a variable. And so which makes me nervous. I'm quite conservative, for the most part, believe it or not. And so I, from my own, personal sake, kind of watching the interest rates myself. And, because ideally, if there's a hint that rates are going to start going up, it would be to my advantage to do an early renewal and lock in at a fixed rate so that I'm better protected. And so I don't know that that's something that a lot of people understand as being something that they can do. So can you just quickly speak to doing an early renewal and locking in your variable rate?
Yeah. So ideally, actually, like if someone's taking a variable, there's actually two strategies really with a variable. Someone, exactly like you said, you didn't want to renew into a 5-year fix at the time. So you took the variable knowing that realistically it's going to come down and we're kind of through the crazy up and down. So there's people like that. And then the other option is people who want the flexibility of the variable and the savings. So if you're going into it for the savings, then you ideally don't want to lock in. However, for early renewals, when that really becomes a thing is, people realistically, if you have a renewal coming up in, say, the next 8 months, you want to have your mortgage professional watching interest rates for you. Because if we do start to see mortgage rates go up, well, then we're going to hold an interest rate for you. And it doesn't really take much for us to hold rates. So people can have someone kind of do all that work for them, basically holding interest rates. And we call it rate insurance, really, because it's protecting you from a higher mortgage payment and higher interest rates. for renewals, we're not really seeing the shock that we saw in 2024. We have about 14 months left of people renewing from pandemic era interest rates into these more normal rates. And now they're kind of coming into that 3.99 to 4.5% range. And it's not such a shock, but it's definitely worth having the conversation months in advance so that you can start to plan the family budget. So you know what that looks like, your mortgage payment is going to look like. And then also to have someone who is actively watching rates for you so that they know when to have you early renew if it means you're going to save money versus waiting until your maturity date.
For sure. Yeah. Like we see it all the time on the news about, the amount of people that need to renew their mortgages because they locked into, a 5-year, 3-year, 5-year fixed back during the pandemic.
At lower rates.
At lower rates. And
much lower.
I just wanted to hear from you. Oh, I lost my earpiece there. Is the renewal shock as bad as predicted, like what we're seeing in the news? And what are you seeing on the ground?
Yeah, so in 2024, I would say it was a big shock. It really was, because people were going from, the 2% range into 5 to 6% range. It was a huge jump for some people. I would say around May, June of this year is when it started to soften. It's still an adjustment because if you're used to paying $199, you are paying more money now. But the good news is that, again, it just comes down to a mortgage strategy. And so do we extend out the amortization a few years just to kind of, if cash flow is a major problem, then we want to extend out the amortization so then we can bring that payment back down a bit. But realistically, most people are faring fairly well. If they don't, so one of the things that we are seeing is people are using their renewal as an opportunity to potentially sell that house. If someone, say, purchased during like 2021, odds are they kind of overpaid for a house and they're reassessing whether or not that house meets their needs. Is it worth it for them? And so they're using the renewal as an opportunity to take that time to actually look at if they want to stay in that house. If not, they're selling and then they're moving. And so renewals are a really great opportunity for that. If they're sitting with any sort of debt, they're taking that opportunity to clear that debt at renewal because you have this opportunity. Renewals really are like such a great opportunity to reassess everything, your financial goals. Does your house meet your needs? Think about what your life looks like and your lifestyle looks like 5 years from now. If you're aging, do you still want that 2-story or do you want to go down to a bungalow or a more manageable home? Renewal is the time that you want to actually do that. But I can say that it's not as shocking of a rate adjustment from where you are today.
Yeah, no, you were just talking about amortization. I have a thought on that. I know when I first bought my first house, this was back in 2008, there was a 40-year amortization at that period of time. Are we still at the 25, 30 year right now? What's the longest amortization period? A buyer can get these
amortization. So the highest you can actually go is a 30-year. But sometimes if we want to keep, when you go to a 30-year and you're not a first-time home buyer, that then becomes an uninsured interest rate. And so the rate, because basically your interest rates is a tier, and you've got your insured rates, and then you have insurable rates, and then you have uninsured. And all that means is who's paying the mortgage insurance. Insured means the buyer is paying the mortgage insurance. Insurable means the lender's paying the insurance. And that insurance, what it does is basically it securitizes the loan. And so you're able to get lower interest rates. When you refinance or you move up to a 30-year amortization, that removes the securitization because we can't securitize those loans. So then that becomes the highest interest rates on the pricing tier. So when someone says, can you quote my interest rate? Well, sure. Once you tell me your beacon score, your loan to value, do you have current insurance already on the property? Are we refinancing or are we switching you from one lender to another? Because at renewal, you have the opportunity to take your mortgage and do what's called a switch. all that means is you're literally picking up your mortgage and moving it over to this lender. And the reason why you would do that is to secure a lower interest rate and maybe a better product. But to do that, we can't take out new money. As soon as you take out new money, that's called a refinance. So a renewal switch is just basically we're moving from one lender to the next, and you do that to secure a lower rate.
Well, and this, I think, is one of the advantages of working with a broker such as yourself. You're able to sell products from everybody's baskets, as opposed to dealing directly with a bank who's only able to offer you funding from their own lending portfolio. So I think this is also where I think it becomes critically important, particularly, maybe for young buyers who don't have a lot of life experience, to work with someone such as yourself to get that value add and that additional advice that they might not be getting by working directly with one of the big banks.
Yeah, it's one of the, I have a fiduciary duty to lenders to make sure that I'm placing the appropriate files with their financial institution. But at the end of the day, I don't have a boss. My clients are who I actually work for. Mm-hmm. And just so people understand, we're paid pretty much the same across the board. So it's not and when there is a rate sale or additional commission, it's because the interest rate has been discounted further. So you actually win, or sometimes we're able to use that extra commission and buy the rate down a little bit further. So there's strategies of working with a broker versus walking into a branch. I'm just simply not limited, and my advice is 100% geared to what is in the best interest of my clients.
Absolutely. And so with that said, Michelle, you are working with a broad spectrum of different, borrowers, be they, first-time home buyers who are just kind of entering the market to, people my age, middle-aged, who are maybe working on their third or fourth house and, maybe need to refinance to send their kid off to university, who may want to do some renovations and pull some equity out of their home, what have you, to senior citizens who might want to plan for, the latter stages of their life. And so with that in mind, what do you feel might be the biggest challenges for buyers and sellers facing financing or obtaining financing right now?
I would say right now the biggest challenge is going to be appraisals coming in short. A good example is I have a client whose house was appraised, I think it was 4.5 months ago. It was $860, and it was appraised 3 weeks ago at $825. The other challenge is going to be for people who are selling and buying at the same time. Where the mistakes are being made is someone is not listening to their realtors, because people have what they feel is they think their home is worth. And it might be because they've added a new kitchen and they have an emotional investment in this property, and they feel their house is worth $570, but the market is telling the realtor that the house is worth $500. And what I'm seeing as the main issue is they're not listening to their realtor, and they're listing at where they want it to sell for. And then it sits. And then what happens is now that house was $500, and now we're 3 months later, and that house is now worth $480. So now they've lost $20,000 in equity. And so for those people, it's a bit challenging if you don't listen to your realtor.
Great advice, Michelle.
Yeah, and I'm just saying that because you're realtors, but that honestly, anyone selling right now, the winners are the ones that just go with what your realtor tells you, because you're looking at the comparables. You understand how to price a home based on the market, because at the end of the day, your house is only worth what someone's willing to pay for it, and the market is going to dictate that. And also, like, the challenges are if someone's not working with, say, a broker and they don't have access to all the different programs and products that we have access to in certain types of lenders, where maybe you might need a bit of private financing because you went in firm and, there's a messy situation. Well, then we're the best tool for that, because we can help you get out of those stickier situations. But I would say softening values in some markets, and if you have to sell and buy and not listening to your realtor and you don't sell your property fast enough.
That's great. So are you seeing many clients that are potentially like turned down or limited by their banks and, coming to you, and you're able to still provide them with numbers that and approvals that work for them?
Absolutely. So the best way to explain this is when first of all, brokers are not anti-banks. In fact, banks are our biggest lending partners. At one time for Scotiabank, brokers represented 60% of the mortgage originations came from the broker channel. We are huge lending partners of the major banks. What I am anti is people walking in and getting financial advice, rates, and products from one financial institution versus working through a broker. Then you get all of the financial institutions, and we're both free, but that's pretty much what the difference is. And what happens is when you walk into the branch, you're really at the mercy of their underwriting guidelines, their products, their interest rates at the time. And so they're limited to only being able to provide you with what they have access to. Versus when you come to a broker, more often than not, I can actually qualify you for more mortgage simply because I have access to different lending programs, like, say, Scotiabank, where I can drop the GDS ratio and then just use TDS, and we can get ratio exceptions. So we can qualify you for more mortgage through the broker channel. If you're self-employed, we have access, like every single lender has their own way of calculating self-employed income. And some are more favorable than others. And especially for my higher net worth clients who really write their income down and maybe they're incorporated, a broker is hands down going to be the best solution for you, as well as we work directly with your accountants if you would like us to, because you want us working together because we can help give basically better advice. And then lastly, I would say, where we are better is, again, if you are credit challenged or, have major debt, just a specific scenario, we have access to over 35 different lenders. I don't think people realize that they actually have access to major banks, credit unions, mortgage companies, alternative lenders, private lenders. And so depending, say you want to flip a house, well, you're going to need a private lender for that. If you're going to, it just really depends on the scenario and the income structure. And that's going to actually determine what is going to be the best lender for their particular scenario.
That's some great information, Michelle. I'd like to kind of segue a little bit into this affordability crisis we've been hearing a lot about. In the last while, we've seen property values skyrocketing, creating an affordability crisis for a lot of our young people. And so, with that said, where do you see opportunity for first-time home buyers in the market right now?
Oh, this is their market. They've been priced to, honestly, I've not had a first-time home buyer in a while. There was a period where they just simply were priced out of the market. And what we're seeing is a mixture of things that have all come together and have created this opportunity for first-time home buyers. One thing about me is I tend to really only try to stay on the positive. I try not to highlight a lot of the negatives because there's so much noise and negativity out there. What people need is calm perspective. And for first-time home buyers, we have rates that have stabilized and are lower. We have a 30-year amortization, which has I think for the insured mortgages, the last number I saw was about 63-65% of insured mortgages are first-time home buyers. They are taking advantage of this 30-year amortization. It has helped tremendously because it's allowing you to qualify for a little bit more mortgage or you can take it and have it as keep the mortgage purchase price the same, but having a lower monthly mortgage payment, so it's a little more affordable for them. Then you have markets where we are starting to see some softening in values. Not every market, but there are some pockets where values have really dropped. And I've personally have had quite a few first-time homebuyers being able to buy in at that $500,000 range, which means the down payments are less. We don't, like when people were trying to buy in 2021, 2022, 2023, they had to have these massive down payments. And so it really just simply meant that they were priced out of the market because they didn't have that. And the last point I would make is you have nothing to sell. As a first-time home buyer, you have an advantage over other buyers because you can go in and not have to sell a property. So if I was someone selling a property and I had to choose the same price point, but like a first-time home buyer or someone who has to sell a property, I'm going with the first-time home buyer because I know that deal's going to close. And so you have these few things that have made it very favorable for first-time home buyers to hop in, but they need to act.
Yeah, we're seeing the same thing as well. We're trying to promote, to first-time home buyers as well as investors that this is an amazing opportunity to move forward with their purchases. But we truly believe that this is an opportunity that we haven't seen for a number of years. Right. So when do you believe, and I think I know the answer, I think Michael knows the answers, but for our viewers here, when should first-time home buyers reach out and what should they expect from someone like yourself or another mortgage professional?
So for me personally, I actually start working with people when they're 18. I want adults to be sending me their children. I'm not taking an application. But what I am doing is educating them on all the steps that they need to start working towards so that they eventually can buy a home. I want to be here to offer hope because with the right plan and strategy, everyone can buy a house, provided that they can build the credit, the down payment, and the income that they need. So the sooner the better. But if you are someone who's already working and you already have established credit, then you want to work with a broker as soon as possible. People often mistake and think that when they're coming to speak with me, I'm taking an application. I very rarely take an application unless I know that we're going to proceed with an actual mortgage. I am able, through 11 years of experience, to be able to interview someone and ask the questions I need to be able to get the information I need to be able to give advice. And our advice is always free. So you want to start working with us because I might ask you something and maybe you have a car payment that has 1 year left of payments. We might be able to talk about how can you hammer down that payment, get rid of the car payment so that you qualify for mortgage. So you want to speak to someone as soon as you even think that there's an opportunity that you might want to buy so that we can make sure you have all the conditions in place so that you are successful when the time comes. You basically can act quickly. The things you want to look for in a mortgage professional is having access to all the lenders because that's going to give you, your best chance of having the maximum mortgage amount that you need. And obviously having financial institutions competing for your business with their interest rates. Next up is when we pre-approve you is basically we use just like a dummy number, like 3,000 as the property taxes. So I might say I qualify you at 550, but we're using 3,000 as the property taxes. Now you might be looking in Tiny Township who has lower property taxes, and maybe the taxes come in at 2,200. Well, I want to rerun the numbers based on the individual property because you then qualify for more mortgage, which means that will help you beat out other offers because you can qualify for a little bit more. So it's really important that your mortgage professional has access to all the lenders, is running numbers based on the individual property itself. And I would say, what else? Just pretty much those two things. Just making sure that, because we're really, the broker is there to make sure that we're always looking for opportunities for the buyer to make sure that they're getting, they're putting their best foot forward and they're aware of all the things that they have access to.
So just like the advice we got from our parents growing up, don't put off to tomorrow what can be done today. Today is always a good time to talk to someone such as yourself and get some financial planning and strategize for the future, such that you're in the strongest possible position you can be in when it comes time to purchase.
Exactly. way. And not even just first time home buyers, but just regular buyers. This is an example of, someone who is going through a separation. I have probably 4 people going through separations right now, and they're at various stages of the separation. And so they have to understand where they need to be before we can move them on to getting mortgage financing. So, or if they think that they might need to sell something, it's the sooner you come to a broker and just have a conversation, we can rule out anything that might be a sticking point so that you have lots of time to address it.
It always starts with a conversation, right?
Yeah. Yes, absolutely.
Sorry, did you have something to
add
there?
I know that one of our clients, I passed on to Michelle, and there were certain things that the client thought was, going to work in their favor, and they will work in their favor. Separated individual. Michelle helped them out as, again, like a first-time home buyer, but there are certain rules and such that Michelle's working, with this individual, that, if they didn't prepare for this beforehand and just purchased a house before obtaining that information from Michelle, they could have got themselves in a real big pickle.
They could have found themselves underwater.
Yeah, absolutely. And there's so much to think about. There's so many ways a file can go wrong. And that's kind of like the tricky part of being a broker is we have to be able to anticipate where is there going to be a potential for a problem and be able to put in place the things that we need to do to make sure that we don't ever get to the place where there's an issue. So a broker is, we help realtors, we help lawyers, everyone. We have to be able to anticipate there's so many professionals that are involved in a purchase transaction, and we need to be able to predict where can there be an issue and then making sure that there isn't an issue that comes up.
I want to kind of address a little monkey in the room, and of course that being, the state of the nation here in Canada, and we have in recent history, we've kind of seen that there's been a slowdown in the market for a number of reasons. I think that there has been some fear and some concern with regard to the government and what their long-term goals are for the nation, and we've had some concerns about our relationship with the U.S. and so on, amongst other things. I mean, there's a lot going on in Europe right now, and everything has a trickle-down effect, as you had noted earlier in our conversation today. And so with that in mind, and being practical and pragmatic, do you think that fear more than fundamentals is possibly driving the slowdown that we're seeing today in the housing market?
Fear, and there is some legitimate things that are happening. But fear absolutely drives a lot of decision making that some people make, unfortunately. It's really if you really think about it, we have news on our phones, news on our TVs. We are inundated with opinions. And I think one thing that I can say here is that, people experience the economy very differently. Our perspectives are all different. How I'm experiencing the economy is not how someone who works at a factory whose overtime has been pulled back. Mm-hmm. And is not the same as a small business who has a product that has to ship to the United States. And so everyone's perspectives are completely different, in my opinion. But what I will say is that is where, and I'm not saying this just because I am a broker, but a broker really needs to be the calm in the storm and trying to stay as nonpartisan as possible. On a personal level, I'm very political. But when it comes to my job, I have to remain nonpartisan as much as possible because you have to be able to cut through the noise. And it is I'm seeing people who want to move, but they're not going to move because their company has pulled back overtime. That is a big issue right now. And so what we really need to see is we have to see businesses start to feel more confident in our economy. And that is going to drive wage increases. That's going to mean, we're not laying anyone off. That means that people are getting their overtime. Like I have a Honda worker whose overtime was pulled back, and at Honda, overtime is a big part of their salary that they depend on. And so that means that they're not going to move now because they don't have that assurance that that money or that income is going to be there. So for sure, there's a lot of fear right now for people in your jobs, not knowing how much food and gas is going to be next year. Like a lot of this is making people hesitant. But if there's something I can say is honest, it doesn't have to be me, just speak with a broker because we can help calm that. And that is where rate strategy comes in because it gives you opportunities to either buy you more time, to feel more confident, to make the leap to go purchase, or to buy that rental investment, like things like that. So brokers are there to bounce ideas off of, but also to give you sound advice that's based on numbers. Like everything I do is not based on opinion. It comes down to math and understanding, we can't predict interest rates, and interest rates can shift like so fast, but we have to be able to understand things that are happening and be able to predict where we think there might be movement and be able to provide advice that is timely and based on math and the economy, and that is it. But fear has definitely been a factor for so many people, like for business owners, for my self-employed clients, 100%. It plays a role for sure.
Absolutely. And we're seeing that, that measure of fear is still very palpable. And that's where I think that, sage advice from someone like yourself might help quell that storm a little bit and maybe offer a little port in the storm. It's always, I think, important to seek the advice of people who know more than you do.
Yeah. And like for me too, like one of the advantages of being a broker is the access to really smart people that I have access to. We, through Mortgage Professionals Canada, through different lenders, through our brokerages, we are constantly in meetings with economists from all the major banks, economists from different associations. So I have access to information that the average person doesn't have access to unless you're working in this industry.
So like everything else in life, there's a solution for everything, right? We just need to consult the people, as you noted, who know more than we do.
So maybe we spoke about this already in regards to first-time home buyers as well as investors. But if we're missing something, like where do you think the best opportunities lie as we close out 2025 and we head into 2026?
I'm stunned, by the way, that we're exiting 2025 already. I'm just saying.
I know. This year flew by because
no kidding.
You and I, we're always working 3 months in advance. So like our minds are looking at January, February closings. So it's like in my head, I have to remind myself I'm not in 2026. But I would say there's a few areas where there's opportunities. It's going to be the move up, move down people. I know homes values have softened, but that also means you're also buying into a softened market. But what I will say that is different right now, and I'm not sure if you guys are feeling this, but for me is it's more calm. We're not having firm sales as much. There's less competition. I personally am finding my buyers it's not as stressful to purchase versus like in 2021, it was stressful when my clients had to go in firm. Otherwise, they simply didn't get the property. And that was like a horrible time to purchase it because you tend to have to make rash decisions and just hope for the best. Whereas now there's a lot more inventory. it's softened a bit, so it's a little easier to make that move. And as long as you're listening to your realtor and pricing your house properly, it's really it's a really great time to move up or move down. So use this as an opportunity to evaluate where your house is at. I don't know if you want to add there, but the other places is going to be recreational properties. There was this mass exodus. I personally had a ton of people coming up from Toronto and purchasing north. They discovered there's this beautiful area north of Toronto. And so what we're seeing is some people who did purchase recreational properties maybe don't want them as much as they thought, because now they're having to drive on the 400 highway and it's not as fun as they thought it would be.
Yeah, we all know what that disaster's like every Friday, right?
Yeah. When they factor in the driving time and they're only there on the weekend, they're like, I don't know if I want this recreational property. So there is that opportunity for recreational type properties. And then the other point I would say is secondary suites. Interest rates have been they were so high for so long. People looking to do major renovations to add an additional suite to their property was really kind of at a reach for them, because it didn't make sense financially to do it because the rates were so high. But rates have come down on the uninsured business, which is what would be a refinance. And where I would say for people to, if it's something you're thinking about, consider it, because, and you guys will be able to speak to this better than I can, but for us, when I have a client looking to purchase a property that has a legal suite, I can qualify them for more money because I can use market rents on that property. Mm-hmm. So when it's time to, yes, it's going to help you pay your mortgage down faster, but also when you go to resell that property, it's a more, people want properties like that. Investors, for an investor, they don't want a property that's just got one unit. We need to have at least 2 units in Ontario, mostly, for them to be able to cash flow that property. So doing that renovation and adding an additional suite does make your house more appealing to a broader range of buyers, I think. And you guys might have an opinion on that as well.
Oh, it absolutely does. I mean, homes that have legal second suites are typically worth more in the marketplace because there is that income potential, which makes them more lucrative to investors, or, even somebody who's just starting out in life. And as you noted, might want to supplement their overheads with renting out a basement apartment or what have you.
Well, and we also have a larger aging population as well, where we're seeing multi-generational families moving in together. It helps financially as well for, maybe the younger generation to have their parents move in to a suite within the house as well. I know there's different incentives as well, government incentives that are in place to do such. So we're definitely seeing, we do have investors as well. They're looking at, properties to rent out. And that's what we're seeing as well, is that if you can find, 2 or 3 units in one place, it makes it very attractive. And we just helped out a client not too long ago. He bought a triplex, and, after running the numbers, he was able to crunch that if 2 of those 3 units were rented out, he was breaking even. So the 3rd unit was just bringing him above. And that made him feel really secure as well, in case he lost a tenant for a little bit. Having multi units within one property is definitely advantageous.
Yeah. And, with respect, Matt, to that one particular client, he's building equity in this property. I mean, historically speaking, with a few hiccups here and there, we've seen the net value of properties increasing over the course of time. And so this particular gentleman is improving his net worth, and, having a property that's basically carrying itself. It's, if you can do it, it's kind of a no-brainer, right?
Yeah, exactly. And we haven't really had the peak in 2021. Investors were also put, not just first-time home buyers, but investors were kind of pushed out of the market as well, because if you couldn't cash flow the property, it didn't make sense. Yep. With interest rates and the market softening and more properties coming onto the market, it's like if you're an investor, it's a really great time to, be out there shopping and looking around.
Absolutely. Absolutely.
Mhm.
So, Michelle, as we kind of draw to a close, and both Matt and I are eternally grateful to you for joining us today. But if you could offer one piece of advice, as Canadians are preparing financially for the next couple of years, what would that one piece of advice be that you might be able to offer?
So I like this question, and it's because there's a different answer for different people. If you're a first-time home buyer, my answer would be, please speak with a broker. And if right now, when you hear people around you saying to you, home ownership is out of reach, I'm sorry, it's not. It is absolutely within reach. You just are surrounding yourself with the wrong people. Please take advice from people who are doing it for other people every single day. If you are self-employed, financial advice would be make sure that you are connecting your broker and your accountant together. If there's any chance that you're going to require mortgage financing in the next 1 to 2 years to purchase, you want to make sure that the broker is running your numbers and giving you an idea of the income we need you to show. And then you take that number and you go to your accountant, and your accountant can look at what they can do to help you get to that number, so that when you do actually purchase 1 to 2 years from now, you haven't mess things up for yourself. And that, because we're all self-employed. We want to write our income down as much as we possibly can. But when it comes to financing, ideally, we want to have an idea of the number we need you to show. And then hopefully your accountant can do their magic and help get you to that number, so that we can get you into the house. For people who have debt, my financial advice is please stop giving your debt birthdays. What I mean by that is if you're holding on to debt longer than a year, they're now collecting birthdays, and it makes absolutely zero sense to hang on to it. If you own a home, I can help you. If you don't own a home, on my Instagram feed, the very first post actually teaches you how to pay down debt. So for people trying to pay down debt going into 2026, because there is a little bit of uncertainty in 2026. And so you want to be positioning yourself in the best place possible, and that is with no debt. Lastly, nothing kills a mortgage approval for purchasing a house better than a Ford F-150. So if you are thinking you want to buy a house in 2026, please defer any big truck purchases because that car payment or that truck payment is going to kill your mortgage approval. So purchase the house, then purchase the truck. And then lastly, my best piece of advice, and it's not because I'm a broker, but I was lucky enough to have a father-in-law push me to a broker. It is use a broker. It is 2026 almost, and it makes absolutely no sense to limit yourself to one financial institution when you have access to all of them, and there's over 35. So that would be my advice for 2026.
That is some really great advice, Michelle.
Yeah, thank you, Michelle, so much for joining us today.
We'll include your contact information at the end of the show, but for anyone who is listening, how do they get a hold of you, either on socials or
so website? I would say Instagram is, so my website is michelledonahue.ca. But I would say go to my Instagram account and follow me on there. That's where I kind of give, economic updates and try to add in, educational pieces, and you can always reach me through there as well. And all my details are in there.
So if people were to follow you on Instagram, they're not only going to get to look at your sunshiny face, they're also going to get these little nuggets of advice as they go along. Yeah,
I try to make it as interesting as possible. Like I've said, mortgages are a dry topic, so it's not I do my best to try to talk about historical economic events and how they relate to today, and just current events, and just the basics of mortgages, so that you're more informed and can make better decisions.
Fantastic. Michelle, I think that I speak for both Matt and myself when we offer our deepest gratitude to you, not only on behalf of us, but also on behalf of all of our clients and anyone who might be tuning in to watch this program. It's been such a delight and a privilege, engaging with you today and getting all of this extraordinary advice to help the people that we work with.
No, I appreciate you guys. You have a very similar love of clients, and I like that. That's important to me. If I'm referring people out, I need to know that they're going to have the same care that they're going to get with me, and that's so beneficial to my business, and I appreciate you guys for that. So thank you for having me as well.
Oh, it's our pleasure. Absolutely our pleasure.
Thank you, Michelle. We hope that you have yourself a great week. We'll be continuing to refer our clients over to you because you've done a tremendous job with everyone we've sent to you thus far, and we know that you'll continue, providing the great service that you do for all of our clients and even for ourselves when we have personal questions.
Absolutely.
In regards to mortgages, we come to you as well. So we appreciate you. We thank you, and we'll definitely be in touch.
Thank you.
Thanks so much for joining us, Michelle. Today, we look forward to harassing you later in the week with our clients' needs.
Yeah.